In this video, we're going to look at CISCO, ticker symbol CSCO, the pros and cons to the stock, what it would be worth if you invested 10 years ago, the dividend history, also which financial institutions are buying and selling the stock, plus a look at the financials and forecasted price targets from analysts, and potentially what a buy price could be. My name is Alex, and this is my Dividend Income channel. First up, a brief history. CISCO Systems Inc. was founded in December 1984 by Leonard Bosack and Sandy Lerner. The company initially focused on developing and selling routers. It went public in 1990 and experienced rapid growth throughout the 1990s. CISCO became a dominant player in the networking industry through strategic acquisitions and product innovation. The dot-com bubble burst in the early 2000s led to challenges, but CISCO diversified its offerings beyond routers and expanded into switches, security, collaboration tools, and more. The company has headquarters in California and is known as one of the largest networking providers. CISCO's history is marked by technological advancements shaping the networking industry. So what are the pros and cons? The pros: number 1, marketing presence and industry leadership. CISCO is a well-established and recognized leader in the networking and communications industry. The company has a strong market position, a wide product portfolio, and a global customer base. Number 2, diverse product offerings. CISCO offers a broad range of networking hardware, software, and services. This diversification helps the company cater to various customer needs and allows it to capitalize on emerging technologies such as cloud and computing, cybersecurity, and the Internet of Things. Number 3, recurring revenue streams. CISCO has a significant portion of its revenue coming from software, subscriptions, maintenance, contracts, and services. This provides a more predictable revenue stream and can contribute to the company's stability and long-term growth. The cons: number 1, marketing competition. The networking and communications industry is highly competitive, with numerous players ranging from established companies to startups. CISCO faces competition from both traditional competitors and emerging technologies, which could potentially impact its market share and profitability. Number 2, technology disruptions. Technology is continuously evolving and disruptions can pose challenges for established companies. CISCO must adapt to changes in the industry, such as a shift towards software-defined networking and virtualization, to remain competitive. Number 3, integration challenges. CISCO has historically grown through acquisitions, which can present integration challenges. Successful integration acquired companies and technologies are crucial for realizing synergies and extracting value from these investments. Integration risks can impact financial performance and investor sentiment. Now let's have a look at how the stock has performed over the last few years. If you invested $10,000 in CISCO stock 10 years ago, what would it be worth today? If you invested $10,000 specifically on June 3rd, 2013, this would have bought approximately 410.17 shares at the closing price of $24.38. Then as of June 2nd, 2023, the value of your investment would have been approximately $25,261.68, based on the closing price of $49.74 per share. That is over a 152% increase. The current dividend pays 39 cents quarterly a share. From those 410.17 shares, you will be receiving $159.96 quarterly, and that is $639.86 annually. If we reinvested the dividends, we would approximately have 560.09 shares and an approximate value of $27,861.57. That is over a 178% increase. This is an average annual total return of 10.79%. From the extra shares, you would be receiving $218.43 quarterly and $873.74 annually. Please note that this is an estimate based on historical data and does not take into account any taxes or transaction costs that may have been incurred. Now let's look at the dividend history. CISCO has been paying dividends out since March 17th, 2011. And if we scroll all the way up, you can see the regular increases up to now, which is 39 cents. Then if we scroll down and have a look at the split history, we can see that they've had regular splits during the 1990s, and then the last one is in 2000, which is exactly 1 month before the dot-com burst. This then saw the stock price plummet, so it's been recovering ever since. The financials: the market cap is $203.83 billion. has a payout ratio of 54.84%, which is good because the dividend is safe and there is room for future dividend growth. Revenue has been steady and it's been increasing over the last 3 years. EBITDA, which stands for earnings before interest, taxes, depreciation and amortization, is being consistent. Free cash flow has dropped a little. You can see there. But if we look at recent quarters, we can see that it's been steadily increasing. Net income and EPS are also increasing, which is great to see. If we look at the cash and debt, cash is increasing and debt is decreasing. And then the dividends have been increasing as well, as we've been talking about. It's better to look at this annually to really see that. If we go back, yeah, so it's increasing, and shares outstanding. They've slowly been buying back shares, which is also great to see. Q3 was generally strong, with revenue up by 14% and non-GAAP up 15% year over year. Their Q4 guidance also forecasted predicted growth. Institutional ownership. Institutional investors hold a majority ownership of CISCO through the 75.72% of the outstanding shares they control. 7 of the top 10 have been buying, a big sell-off from BlackRock Fund Advisors of 4.85 million shares. They still own a 5.28% stake. A couple of smaller sell-offs from Wellington Management and Northern Trust Investments. Fidelity Management and Research making a big move, purchasing 8.7 million shares. SSGA Funds Management buying 4 million, and Norges Bank Investment 2.6 million. Overall, significantly more bought, which instills confidence. Now, what do the analysts think the 12-month forecast of the stock price could be? CNN Business have an average 12-month price target of $55. That's a 9.6% upside from where we are today based on 16 analysts. TipRanks have an average price target of $58.33. That's a 14.25% upside from where we are today based on 17. And Zacks have an average buy price of $53.50, 9.57% upside from where we are today based on 16 analysts. Is it worth buying? If we zoom out over the last 30 years, we can see the stock has skyrocketed as part of the dot-com bubble up to the 2000 crash. After the dot-com bubble burst, it had its highs and lows like all stocks, but has only seen steady growth since 2011. The stock price had a 52-week high of $52.56 and a low of $38.60. The dividend yield is currently 3.11%. Its stock price has had a nice little run up over the last month. I own a small holding in it and I would like to add to it. Its intrinsic value is $44.26, which is around my average buy price. With a margin of safety at 10%, a good buy price would be $39.83, which is very close to its 52-week low. This would be perfect to bring my average price down and build on the position. As usual, thanks for watching. If you've enjoyed the video, please like and subscribe.